Welcome everyone. Thank you for joining us for today's forum. My name is Nadira Maisara binti Nazrimawi with metric number 2890. I'll be responsible for hosting this forum session today, and I'm glad to welcome our panel, which consists of 4 very bright students from University Utara, Malaysia. Here we have Ain Hazwani, Fatia Husna, Akila Humaira, and Khadar Ali. Today we will discuss the comparison between the regulation of conventional debt instrument and regulation of Islamic debt instrument. Just a little housekeeping before we get started. A debt instrument can be either written on paper or electronically. Debt instrument includes bonds, debentures, leases, certificates, bill of exchange, and promissory notes. These instruments allow market participants to transfer debt obligations from one party to another. Generally, the term debt instrument refers to debt capital raised by institutional entities. The main contrasting difference of the regulation of conventional and Islamic debt instrument is the principles that it follows. The Islamic debt instruments follow the divine laws or Sharia derived from the Quran, Hadith, and Ijma. Therefore, there are certain rules that have to be followed. This includes the prohibition of exaggerated advertisements and promotions, cheating in transactions, abnormal markups of prices, private monopoly, and deceptions, which also means riba, garar, and maisir. To further dive into this matter, we will turn the time over to Ms. Ain Hazwani. Please tell us more about the financial instrument in Islamic banking and regulations, Sukuk bond.
Thank you, Ms. Moderator Nadira Maisara. Before I go into further detail on the Islamic debt instrument, which is Sukuk bonds, let me introduce myself. My name is Nurul Ain Hazwani binti Adam, metric number 280088. Without further ado, I will explain about the Sukuk bond. Sukuk is taken from an Arabic word, the plural of sak, referring to a legal instrument or certificate that representing a contract of financial right, obligation, or money transaction that is Sharia compliant. Additionally, Sukuk bonds are similar to bonds but are Islamic in nature because Sukuk bonds are prohibited charging or paying interest. Furthermore, Sukuk bonds are based on the securitization concept, which refer to the issuing of ownership against an asset, investment pool, and business enterprise. Besides that, the securities represent the proportionate ownership of the holder in illiquid or tradable asset. The trade such securities is permissible. According to the Accounting and Auditing Organization for Islamic Financial Institutions, Sharia Standard 17 on investment sukuk, sukuk to be tradable must be owned by sukuk holders with all rights and obligation of ownership in real asset, whether tangible, usufruct, or service, capable of being owned and sold legally as well as in accordance with the rules of Sharia. The manager issuing sukuk must clarify a transfer of ownership of such asset in its sukuk books and must not keep them as his own asset. However, based on Accounting and Auditing Organization for Islamic Financial Institutions Sharia Standard 21 on financial paper, sukuk to be tradable must not represent the receivable or debt, except in the case of a trading or financial entity selling all its asset or portfolio with standing financial obligation, in which some debt incidental to physical asset or usufruct were included unintentionally in accordance with the guidelines mentioned in. As per Accounting and Auditing Organization for Islamic Financial Institution, sukuk based on ijarah, istisna, mudarabah or musyarakah principle are tradable. Non-tradable sukuk represent receivable of cash or goods, for example, sukuk of salam or murabahah. That's all from me. Thank you.
What a fantastic insight from panel 1. Now we know that Sukuk is the Islamic equivalent of bonds, also known as Sharia-compliant bonds. Sukuk bonds are also based on the securitization principle, which is permissible under Islamic law and prohibits the charging or paying of interest. Now, let us take a look at the debt instrument available in the conventional bonds. Panel 2, can you share your insights on bonds?
Thank you, Ms. Moderator. I will elaborate on the debt instrument available in conventional bonds. A bond is a fixed income instrument that reflects an investor's debt to a borrower, typically corporate or governmental. A bond may be thought of as a promissory note between the lender and the borrower that outlines the loan's terms and installments. Companies, municipalities, states, and sovereign governments all utilize bonds to fund projects and operations. Bondholders are the issuers, debt holders, or creditors. The end date when the principal of the loan is scheduled to be paid to the bond owner is normally included in the bond specifics, as are the terms for the borrower's variable or fixed interest payments. In the bond market, there are four main types of bonds, which are corporate bonds, means a sort of debt that a company issues to obtain cash. When an investor buys a corporate bond, he or she is essentially lending money to the company in return for a series of interest payments. However, these bonds may also be actively exchanged on the secondary market. In the United States, corporate bonds are usually seen as riskier than government bonds, and their interest rates are often higher to compensate for these credit risks. Second, municipal bonds are issued by states, cities, countries, and municipalities to pay ongoing commitments as well as capital projects such as school construction, road construction, and sewer system construction. Some municipal bonds offer tax-free coupon income for investors. When you purchase municipal bonds, you are basically lending money to the bond issuer in exchange for the promise of regular interest payments, usually semi-annually, as well as the return of your initial investment or principal. The maturity date of a municipal bond means the date on which the bond's issuer repays the principal might be years. Long-term bonds mature in a decade, but short-term bonds mature in 1 to 3 years. Third, government bonds are often issued by a national government and denominated in the country's currency. Sovereign bonds are government bonds issued in foreign currency by national governments. The interest rate charged by investors for lending money to governments reflects inflation expectations as well as the probability of debt payback. Bonds are issued to raise revenue by governments and businesses. By acquiring a bond, you are making a loan to the issuer, who promise to return the face value of the debt on a specific date as well as pay you periodic interest payments along the way, usually twice a year. Last, agency bonds are those issued by government-sponsored enterprises or a federal government department other than the U.S. Treasury. An agency bond is often referred to as agency debt. The majority of agency bonds have a semi-annual fixed coupon. They are offered in various increments with a minimum investment amount set by the agency. Agency bonds are one of the safest investments in the world of fixed income instruments, and they are sometimes compared to treasury bonds due to their low risk and great liquidity. Last but not least, to illustrate, consider the case of SYZ Corporation. SYZ wished to borrow 1 million to finance the construction of a new factory, but it is unable to obtain this financing from a bank. Instead, SYZ decided to raise the money by selling 1 million euros of bonds to investors. Under the terms of the bond, SYZ promised to pay its bondholders 5% interest per year for 5 years, with interest paid semi-annually. Each of the bonds has a face value of 1,000, meaning SYZ is selling a total of 1,000 bonds. That's all from me. Thank you.
Thank you, Panel 2, for the very detailed explanation about the conventional debt instrument, consisting of four main types of bonds, which are corporate, municipal, government, and agency bonds. Next, panel 3, can you enlighten us with the comparison of regulation in Islamic and conventional debt instrument?
Thank you, Ms. Moderator. Now, I will explain the comparison of regulation in Islamic and conventional debt instrument. The guidelines on issuance of corporate bonds and sukuk to retail investor are issued by the Securities Commission Malaysia (SC) under Section 377 of the Capital Markets and Services Act 2007 (CMSA). Requirements for issuance of corporate bonds and sukuk. First, credit ratings. All corporate bonds or sukuk must be rated by a credit rating agency registered with the SC. This does not apply to an issuance of the following: convertible loan stock or Islamic loan stocks, convertible bonds, sukuk loan stocks or Islamic loan stocks, and exchangeable bonds or sukuk which fulfill the following requirements. Holder of such product are given the right to convert or exchange such products into underlying shares at any time or within a reasonable period during the tenure of such products, and the underlying shares are leased and called on a stock exchange. The final credit rating for the corporate bonds or sukuk must be made available as part of the submission for approval that is made to the SC. Where the final credit rating is not available, an indicate credit rating must be submitted to the SC. Second, implementation time frame. Any corporate bonds or sukuk approved under these guidelines must be implemented within 1 year from the date of the SC's approval, except in the case of a debt or sukuk program. For a debt or sukuk program, the first issuance must be made within 2 years from the date of the SC's approval. Approval sukuk for issuance of corporate bonds and sukuk. The SC may grant its approval and, where applicable, register the prospectus for a proposed issue or corporate bonds or sukuk subject to receipt of complete set of document and full compliance with relevant requirements as provided in these guidelines. The approval from the SC for a debt or sukuk program is granted on the basis of continuous compliance by the issuer with all the requirements in these guidelines. For the purpose, a complete set of documents must include the following for issues other than a qualified issuer. The information and documents as set out of these guidelines: a prospectus, a product highlight sheet (PHS) that complies with the requirements set out in the guideline on sale practice of unleased capital market products. For qualified issuer, the information and document as set out of these guidelines, a PHS, where applicable, an information memorandum, including any supplemental or replacement information memorandum. For the purpose of prospectus registration, the prospectus submitted to the SC must be complete and fully comply with the relevant requirements of the prospectus guidelines. Qualified issuer framework. They set out the eligibility criteria for issuer who may issue corporate bonds or sukuk under the qualified issuer framework. The requirements set out under this chapter are in addition to all other relevant requirements set out in this guideline. An issuer specific who fulfill the following criteria may be a qualified issuer. The issuer has issued or guaranteed corporate bonds or sukuk with an aggregate amount at least 500 million in the past 5 years, and the corporate bonds or sukuk to be issued have a minimum credit rating for AA negative or its equivalent. A qualified issuer may issue corporate bonds or sukuk to retail investor without a prospectus, provided that the qualified issuer prepared a PHS in accordance with the guidelines on sale practice of unleased capital market product. So that's all about the comparison between conventional and Islamic debt instrument.
Thank you to our third speaker for the detailed explanation on the contrasting regulations of the Islamic Sukuk and conventional bond. As we know, the Securities Commission regulates the Islamic capital market in Malaysia, which ensures Sukuk is in line with the Islamic principles. Therefore, both the guidelines on issuance of corporate bonds and Sukuk to retail investors are issued by the Securities Commission Malaysia under Section 377 of the Capital Markets and Services Act 2007. From what we can infer, a high value is placed on Sharia-compliant status in Malaysia, which necessitates a great deal of thought and procedure in choosing a halal way of being indebted. Next, can anyone share about the impacts of Islamic debt on company value?
Thank you, Mrs. Moderator. Now I will talk about the impact of Islamic debt on company value. The impact of Islamic debt on company value and financial performance. This statement demonstrates that the debt and corporate financial performance have made several significant contributions to corporate finance. First, it demonstrates the influence of Islamic debt on companies' reputation and financial performance. Second, it is quite essential since it adds greatly to some of the studies done on this sort of budget. The model to be employed is determined by the diagnostic test findings of non-formality and non-uniform dispersion. A test is conducted before to the diagnostic test to confirm that the dataset is free of outliers. Furthermore, it offers volatility and integration testing, the data dynamic panel generalized method of moments based on the diagnostic results from a quarterly balance of 80 Malaysian Islamic loan users from 2000 to 2009. It will be examined. This approach is used to examine the influence of Islamic debt issues on business value and financial performance. This findings indicates that the Islamic debt has a substantial and beneficial influence to confirm the value and financial performance. It also indicates that the trade-off hypothesis is applicable to Islamic loan finance in Malaysia. Finally, the Islamic debt coefficient is greater than the non-Islamic debt coefficient, indicating that the Islamic debt adds considerably to business value and enhance the financial performance of companies compared to non-Islamic debt. That's all from me. Thank you.
Thank you to our fourth and final speaker, Kadar. In conclusion, both the Islamic and conventional debt instrument referring to Sukuk and bond respectively have their own differences. With that being said, as Muslims, we should in fact follow the Islamic teachings as it is beneficial for both parties while still boosting economic growth, reducing poverty, and fostering shared prosperity. I believe we may all benefit from the information we gained today. Special thanks to all four panels, Ain, Husna, Akila, and Kadar, for the great forum session. It was a pleasure to have you with us. Thanks again for joining us today, and we will see you again next time. With that, I shall wrap up today's session with Wabillahi Taufiq wal Hidayah. Assalamualaikum warahmatullahi wabarakatuh.
Allocate some of you guys' parts into different parts. Maksudnya round lain tu into different rounds.
2 round.
Yeah, so it'll be like 2 rounds, not just
one person speaks for like a long time and the next person talks for a really long time. So it's like an interaction basis.
Kalau macam aku kan, dia panjang kan. Panjang ni kena buat 2 round jugalah. Taklah panjang sangat.
Aku still macam trying to figure out macam mana aku nak bahagi